Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The S&P 500 hit a record high for the 51st time this year. Ross checks out an advance in crude and how the U.S. and Canadian dollars are doing. Recently retired BC broker and longtime financial advisor Victor Adair shares his thoughts on the record flow of money into the markets, quantitative easing, interest rates, gold, crude, politically correct investing, and the outlook for the U.S. dollar. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money, Ross.
Always good to be here, Jim.
Wall Street must be a happy street. For the 51st time this year, the S&P closes with a record high.
It does, and this is, what's that? Probably just under a quarter of the days of this year have had record high closes. You know, the corrections are getting milder, and they're getting shorter. The ones that we had in the end of July were probably 4 or 5 days. By the time we got into August, it was a 2.5-day move. Both of those providing short-term oversold signals in our work, which kind of surprised me how easily they got down into that category and turned the corner. But once again, if we take a look at the internals, that the NYSE, the AD line, still is now well short of the highs that it put in a couple of months ago. And if you look at the S&P 500 and the breakdown of that index, once again, the advanced declines show that it's not doing that well. So it's the big cap names. It's the ones that have that high capitalization within the index that are really helping to move it along. And, some of these things get a little ahead of themselves and take a bit of a pause. You know, like we had Moderna and Pfizer gave big exhaustion signals for us in the last couple of weeks. Got the reversal very easily in Moderna, and looks as though Pfizer has now turned the corner. So, when they finally get their official approvals, it's sell the news rather than buy the news, and it looks as though those ones are ready for a decent correction right now. The good one of the week, though, was over in energy. A week ago, we put out a report showing how the crude was correcting. It was down into the 62.5 range, down from 77, getting close to targets. We thought it might just have a short drop under $60, but it had almost retraced 38%, which would be a normal Fibonacci retracement there. And on Sunday night, all the bells and whistles went off on our programs. We had the right kind of an oversold that we look for at an interim low, not just a minor one, but a good solid signal, not only in crude oil, but it kicked in with signals on the ETFs, like the XLE in the U.S., the XEG in Canada. And, the most oversold ones were things like Suncor, Enerplus, and ARC, and those this week were up anywhere from 9 to 17% on the week. So, for all that the broader equity markets that everybody's watching, making headlines, the real moves and the money is made coming off of bottoms. And so far, the move off the bottom this week in energies has been pretty stellar.
What's going on with Bitcoin right now?
That's one that formed just a beautiful base in May through the latter part of July. The first, it had that hard break into May. We got our capitulation readings. Then you had a couple of good tests of the lows. And right at the end of July, it took out the low and sprung that very quickly, turned the corner, the kind of thing that you look for in an accumulation pattern. You want to get the weak longs out of the marketplace, and eventually they'll come back in once they see that the uptrend has reasserted itself. And so about 2 weeks ago, had a nice breakout of the consolidation that we were in on expanding volume. We got some good overbought signals, which is what you want to see. You want to see that sign of strength as something starts to come to life. And shortly after that, we had mild correction. And it's just been walking its way up. I think we hit 50,000 this week, pulled back to 47 and change. That market in Bitcoin and the similar products in the crypto look as though they've got lots of legs in them. Minor corrections, I'm thinking like any 3 to 5 day correction you can take a serious look at buying into. And, you don't have to buy the actual coins. You can go out, and there are enough ETFs trading these days that it's easy enough to find something that's an exchange-traded item. You don't have to go through all the bells and whistles of opening an account and creating a wallet for yourself for Bitcoin. Just take a look online, and you'll find some decent products out there with liquidity, lots of ease of ability to get in and out of these markets.
How are the U.S. and Canadian dollars doing?
Well, this was the Jackson Hole day on Friday, and here we have Chairman Powell being fairly dovish, and so with that, the tapering, is still out there in the horizon somewhere, but nobody's willing to establish a date. And with that, the U.S. dollar turned weak during the day. Canadian dollar had a pretty good bounce, and closed back the week here at 79 1/4. We always look to see how it's performing relative to commodities. So this is still a good cent and a half off the high that we put in the middle of the summer. And I would expect that it's going to have to get through that 80.5 cent level, along with some strength in the oil market, or we're going to end up back down retesting the lows again.
Ross, anything else we should be keeping a close eye on the markets right now?
Some of these other items that have been affected by weather, things like coffee and sugar, those are probably still going to have a bit of a run. Natural gas was one that really had 2 strong days at the end of this week. We've been hoping that we could get an August-September correction in there. And, if the weather subsides a little bit in the next few weeks, I think that you've got to be willing to buy any good solid dip in that natural gas. Anything probably back in the 370-ish range would be something to take a look at. Put that on the back burner and be ready for it if and when it comes.
Ross, thank you so much for being on This Week in Money.
It's a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Victor Adair, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC. Check out his website, victoradair.ca. Welcome back to This Week in Money.
Well, thank you, Jim. Always a pleasure to talk with you.
Victor, we've been hitting all-time highs on the major North American stock markets now for months. Is this a stock market in a perpetual motion machine?
Well, it certainly seems that way. It seems almost every couple of weeks or every week we're getting new all-time highs. The S&P is up probably just about 20% this year, and it's a little better than a double from the lows that we hit during what I call the COVID panic of March of last year. Just recently, say the last 4 months or so, we've had a little dip in the middle of the month, each of those last 4 months, but the markets come right back and made new highs after that. I think the last time we were down, anywhere over 5% on the S&P index was sort of August of last year, or September of last year, September into November. So we've gone for almost a year, I think, without as much as a 5% correction. So yeah, it seems like it's a perpetual motion machine. Some of the things that are driving it, here's certainly, people are putting money into the stock market like never before. There's that. Corporations are doing buybacks, share buybacks, at a very strong rate. But here was one little fact. I picked this up, that Apple Corporation has been buying an average of $1 billion a week of their own stock for the last 8 years. Total buybacks by Apple over the last 8 years, about $420 billion. And that is more than the total market capitalization of most of the stocks. Actually, 489 of the stocks that are in the S&P 500. It's just to give you some idea of size. When I talk about money coming from the public into the market, we call this flows, and they are record size. A lot of the money is flowing into passive investing, in other words, cheap management fee ETFs that just buy the indices as opposed to trying to pick stocks. But there is leverage like never before in the market, and by that I mean, people, let's say you're buying a share that costs $100, you'd put up $50 or $60, and your broker would lend you the rest, so that's leverage. And everybody that, understands the real estate market gets leverage. If you buy a house for only 5% down and the house price goes up by 10%, you've made 200% on your down payment, as it were. So leverage is attractive in the stock market like never before. You have Bob Hoy on the show a lot, and Bob's a long time friend of mine. I guess we've known each other for at least 40 years. And Bobby likes to talk about how people will choose what they speculate in. From time to time it'll be in commodities or in maybe gold stocks or tech stocks or marijuana stocks or whatever. And, there's all these acronyms like FOMO, the fear of missing out, TINA, there is no alternative, and so on. And there's certainly some background of truth in all of these things, that as people just see the stock market, it just goes up. So the basis of passive investing kind of is you give your broker or your brokerage firm or the mutual fund firm, whatever that you're investing with, you give them some money every month, like it goes clipped off your paycheck and goes into the market regardless of where the market is. And you're sort of subscribing to the view that it doesn't matter, that over time, the market just keeps going up, so just put a little bit in all the time, kind of average your way in, and, you'll end up with a lot more money than you started with. Another thing that's happening here is that people who short the market, expecting it to go down, are, they've obviously had their ears boxed, but they're just not doing that anywhere near like what they've done for a long time. It's what we call the short interest is at about a 20-year low. So people that are shorting the market are basically given up or stopping doing that. I see the online brokerage firm Robinhood, which is sort of particularly focused at the millennial age group, has 24 million accounts now. They've just gone public and their stock's gone up in price. And just, here's one final thing to throw at you. Last week, which was kind of a ho-hum week, really, in the market, the Dow Jones had a 1,000-point range between the high and the low. I mean, I remember trading the markets when the Dow Jones was at 1,000 points, and that had been the highest it had ever reached. So, we've got kind of a complacency, I think, in the stock market only goes up idea, to come back to your perpetual motion machine. And just at the very core of my being, I'm suspicious about things like that. So I just keep, and so are some other folks that keep thinking at some point we're going to get a scare in this market where, typically the market trades off a little bit. A whole wave of people come in doing what we call buy the dip. You get a little bit of a bargain. One of these days, we're going to see the market take a break, and the buy the dip crowd's going to step in there and buy it, and the market's going to keep going down, and then, we'll see who had Wheaties for breakfast and who didn't.
The much anticipated Jackson Hole Fed meeting is happening this week. What impact is that having on the markets?
There was a lot of anticipation ahead of the Jackson Hole, and anticipation particularly as to what Fed Chairman Powell would say, because he's the keynote speaker, and I think there's 100 different people there delivering papers and talking, people from around the world, central bankers and finance ministers, academics, and so on. But I mean, he's the star attraction, I suppose. And he spoke on Friday morning, and at the end of the day, the market took what he said. If you could just boil it down to one thing, it would be, we're not going to be raising interest rates anytime soon. Oh, great, said the market. So the stock market is up, the U.S. dollar is down, gold is up, and commodities are bid. That was kind of, the market had been holding its breath, that maybe he would surprise the market, and he has a couple of times in the past, and I think been stung for doing that. So now it seems that, his purpose is to not surprise the market with anything he says. Just to put a little different spin on that, I mean, the Federal Reserve, it's over, I guess it's almost 110 years ago that it started. But there was a time back in the 1950s and 60s, before there was color television, when the head of the Fed was William McChesney Martin. And he was famous for saying something to the effect of, the job of the Federal Reserve is to come and take the punch bowl away just before the party really gets going. And boy, oh boy, that is clearly not what the Fed does these days. In fact, it seems these days the Fed has so many different self-assigned mandates that you wonder if they even have time to do what they were supposed to be doing in the first place. So that's a little coarse, but I mean, you hear them, they're talking about like they have a responsibility for climate change, for inequality, and that sort of thing. And I think for sure maybe the Fed talks too much. It used to be, you might get a note from them, somebody saying something once a quarter. Now, every day there's a few people from the Fed that are out, offering their 2 bits worth as to what's going on in the market and what the Fed should be doing. I think there's a thought that the Fed, and I could kind of subscribe to this, that the Fed's painted themselves into a corner. They got interest rates down to virtually nothing. Real interest rates are negative. Their quantitative easing program seems to have lost its effectiveness. In other words, they're buying, and have been since March of last year, $120 billion worth of paper a month. That's roughly $80 billion in bonds and $20 billion in mortgages. And given what Powell had to say this week, they're not going to start to taper that anytime soon, although, we've seen some improvements in the economy and so on. And I would say that not only have they painted themselves into a corner as to what are they going to do if they decide, inflation, say, is picking up or the economy is really picking up, they decide that they need to stop these emergency measures, and they would know full well that the stock market would probably freak out, or other kind of a technical term, if that happens. So we'll see. I mean, I also think that, they talk about inequality, and I can't imagine there's been anybody really that's created more inequality than they have, because it's the rich people who own stocks, and stocks have gone up while they've pushed their program, and the poorer people don't own stocks. So they have some responsibility for creating inequality, but maybe that's going down a rabbit hole if we go down that path, Jimmy.
2 weeks ago on your blog, you wrote about the big sell-off in Chinese tech stocks and how it might impact other stock markets. Well, what's happened since then?
Yeah, you go back to, I think it kind of started with Jack Ma last fall, when he was kind of reined in or disciplined, whatever, by the authorities. But certainly in terms of the Chinese tech stocks, and they were smoking hot, let's say last fall into February, where they peaked. But the index, the Chinese index of tech stocks, is down about 40% since the highs hit in February. And by the way, during that same period of time, U.S. tech stocks are up more than 10%. So there's been a hell of a gap open between those two markets. And what has happened really is, it seems, from my perspective, that the authorities are clamping down on what I call the rich and famous. The guys that were at the head of these firms that were, multi-billion-dollar firms, doing huge amounts of business, all kinds of customers and that sort of thing, and they were maybe enjoying the limelight. And again, I'd go with Jack Ma, seemed to be the leader of the pack in that department. And the authorities just said, we don't like that. We don't want that, and that's not going to happen anymore. And they're closing the door with rules and regulations of all kinds, and the stock market's voting with its feet, and prices are going down. So just as a juxtaposition, back in the 1980s, the Zeitgeist, to say, in China was, it's glorious to be rich. And I wrote about that in my blog a couple of weeks ago, about how so much has changed since then. The country has got so much more wealthy in that 40-year period. And now maybe some of the guys who generated all of that wealth, that was going to be capitalism with Chinese characteristics. That was the term. And so some of the people that made it all happen are, seen, I think, as a threat by the authorities. So they're clamping down on those folks. And the new term is they want common prosperity, which would be, I call it equality with Chinese characteristics. So they would sort of go to one of these leading firms and recommend that the firm, donate a few $1 billion to this project or that project. And they're going to have rules and regulations to keep them from doing things the authorities don't want them to do. So the Chinese market had that tumble, and my question a couple of weeks ago anyway was, will this be contagious? And we see a lot of contagion in markets because a lot of markets are interrelated in different ways. It didn't seem to have an impact on the North American tech sector. If anything, there might have been some capital that had been invested in the Chinese tech sector that came into the American tech sector and helped lift those prices even higher. There did seem to be some impact, let's call it a risk-off tone, come into the market 2 weeks ago, in particular into the currency markets. We saw the U.S. dollar rally, and again, commodities prices came down. So, in one respect, that would mean a weaker Canadian dollar, weaker crude oil. But, here this week, those markets have certainly bounced back from their lows. So maybe what's going on in China, as dramatic as it is for the second largest economy in the world, hasn't had any impact so far, and maybe won't. But it's just one of those things out there you have to pay attention to.
Well, China has decided to crack down on Bitcoin miners because of their energy use. It could be a big benefit for Alberta because they have all this oil and gas they want to use up, and people are building and proposing Bitcoin farming farms in Alberta. So could Canada actually gain from China's loss?
I've seen stories to the effect that Bitcoin miners are going elsewhere because of the shutdown in China. That's about as much as I know about it, Jimmy, but just from a general point of view, when there is demand somewhere and there is a clamp put on supply, then, supply shows up someplace else, which is exactly what you're talking about. Whether it happens in Alberta or Vietnam, I don't know.
During our previous interviews this year, you've generally been bullish on the U.S. dollar. Do you still think that way?
I'd say generally I do, yes. We had the U.S. dollar touch a 3-year low at the beginning of January, and we've talked about this in the show before. It was the day when the Capitol building in Washington was stormed. It was January the 6th, was the low day of the U.S. dollar for the last 3 years. And the market began to rally from that. I remember watching that action on the television news that night or whatever during the day, and I was actually sort of horrified. I thought, oh my God, look at this! And the whole world is seeing this. These guys breaking into the legislative building in the Capitol. What does the world think is going on in the United States? And it was that George Soros would call it an inflection point. Or, the old term was, you need to buy the market when the blood's running in the street or something like that. But whatever. It was a 3-year low hit that day, and the dollar has done better since then. Just last week it hit a 9-month high. Part of this, in currency trading, we're just trading one currency against another. And believe me, I know America is beset with all kinds of problems. It would just seem that other countries are beset even more with problems. So therefore, the U.S. dollar goes up because it's the cleanest dirty shirt in the laundry hamper. That's been one of the expressions about the U.S. dollar for years. Generally speaking, and this is so general that it's almost painful, but when people are buying the U.S. dollar relative to the other currencies, they're probably worried about something. There's a bit of a risk-off tone in the market. So we certainly saw that last week when the U.S. dollar was getting bid higher. I mean, there are a number of things to worry about in the markets these days. But then here this week, the U.S. dollar has come back down off of those highs. So, if there was an old-fashioned expression would be, what, me worry? Seems to be the complacent tone in the market right now. So generally I like the U.S. dollar, but day to day, my trading is pretty short term usually, so I don't say, I believe in the U.S. dollar and I'm going to buy it and hold it come hell or high water. I just don't trade that way. But I think the U.S. dollar, if I was to try to make a bet, is the U.S. dollar going to be higher or lower by the end of the year? I'd say higher, and probably the reason for that is I'm anticipating, we may have some real intense drama in the markets as we go into the fall. I think we've had kind of a complacent summer here. A lot of positioning is happening, that's complacent positioning, and any number of things could hit the fan here to give us some rock and roll. So, if I had to bet, I'd say the U.S. dollar probably continues to go higher.
The Canadian dollar had a great run from last year's lows to hit 83 cents back in June. It dropped to 77 cents last week. Then it bounced back about 2 cents from there. Now, is the loonie going to go dive for some deep fish or climb to the stars?
Well, I like that. The Canadian dollar hit a low of 68 cents in the COVID crisis, March of last year, and then they had that steady rally to 83 cents in June. That was a 6-year high that the Canadian dollar hit in June. You remember now the U.S. dollar was aggressively bid during the March panic of last year. As I was just saying, people, when they get worried, they run to the U.S. dollar. And then once things kind of, the panic went out of the market, because the Fed in particular and other central banks just came in massive size to bail the market out. So stock markets were rallying all of last year from the March lows, and the U.S. dollar was falling. So that was a good background for the Canadian dollar. And then certainly the Canada also was going up as commodities were going up, and commodities would generally go up in an environment where there's a weaker U.S. dollar. I mean, these things are always interrelated. Now, the positioning in Canada was interesting, particularly from November of last year, and that was a key date because Biden got elected, and it was a major change in government in the United States. Some people might dispute that, but just, forgive me on that. We went from Trump to Biden. And 2 days later, Pfizer announced the vaccine, which seemed to give the market extra kick of enthusiasm. So from that point to June, speculators built a larger and larger position long the Canadian dollar. They got to actually a multi-year record. When I say speculators, really I'm meaning hedge funds and so on. And then when the Canadian dollar started to dip a bit from that high at the beginning of June, the speculators added to their position. It was a classic case of buying the dip on the Canadian dollar. However, this time that didn't work, and the Canadian dollar continued to slip lower, and those people had to blow out their positions, and they did. And we had the Canadian dollar drop from 83 cents beginning of June down to 77 cents at last week's lows. And the lows were made last week on the Canada. I think that selling from the speculators would have accelerated the downtrend. There was also this unease in the market that perhaps certainly inspired in part by China, but COVID crisis was happening. Crude oil prices were falling as the supply-demand balance was changing there. So Canada just came off pretty hard last week. And then when the risk-on tone came back here this week and toward the end of last week, Canada bounced 2.5 cents. I think in some respects, you've got to pay attention to this. We're in the late couple of weeks of August. Those are generally a lot of thin conditions during that period of time. Going forward, we'll see, as I just was saying about the U.S. dollar, I think there's going to be some stress at least start to show up in the markets this fall. And, Canada, if U.S. dollar is going to be bid, as I'm thinking, Canada might be under pressure.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Victor Adair. Victor, since we last talked at the end of August, gold dropped and then rallied back well over $100. What happened, and what do you see ahead for gold?
Yeah, the last time we talked was, I guess it was near the end of July. Then on August the 6th, the unemployment report in the United States was much stronger than had been expected, and the U.S. dollar surged on that and against other currencies. And gold started to fall, and then gold broke through the lows that it had, say, of the previous 3 weeks or so, and closed the week right on its lows. The August the 6th, unemployment day, it was a Friday. Then what happened on Sunday afternoon, North American time, when the markets opened in the Far East, just sort of suddenly, in 15 minutes kind of thing, there was a spike down in gold. And what that looked like was what we would call a margin clerk selling somebody out or blowing out somebody's position. You could imagine, say, there had been a hedge fund that had been long gold and got stressed when the price closed right on its lows on Friday. Over the weekend, the brokerage firm or whatever assessed their risk and said, we need to liquidate this position, and they give it to the margin clerks, and the margin clerks just hit any bid. Well, I mean, if you're going to do something like that in a market like gold, the best time to do it would be 5:30 in the morning, West Coast time, 8:30 in the morning, New York time, when both London and Europe and New York are all open. That is the heaviest volume half hour of the 24-hour day. But this was done in very thin conditions in the Far East market. It's a 24-hour market we're trading, but like that. And the market just spiked down. And then, within an hour or so, a lot of that had been recovered. Some people obviously had their stops hit, that people had been long gold, so it was a washout. We probably made a very important low on that day, that Sunday afternoon, and it'll show up as a Monday on a lot of people's charts. I mean, if that low is taken out at some point in the future, then you've got to think gold's in pretty tough shape. We've come back since then, even as the U.S. dollar made a high last week. I think we have gold now has had a range in the month of August of, let's say, a good $125, $125, and ending, looks like we're ending the month here right near the top of that range. So that's good. One of the things about gold that's a little troublesome is gold stocks look awful, certainly relative to gold, but just by themselves, awful. They haven't really had much of a rally. When I say gold stocks, I'm looking at the gold share index, although I do look at a number of the individual issues. I mean, for instance, say Franco-Nevada is doing way better than Barrick. There is that. But just generally, gold stocks look like if they take out the lows they made this week, last week, then it's probably another step down. The junior gold miners also look tough. So, I don't know why that is so much. I just see that's how it is. I don't have a position in gold one way or the other. I could be a buyer or a seller, but I just see that the gold stocks look a little weak, and I don't know why that is, particularly and it just may be, honestly, that, people would rather buy Bitcoin or shares in Apple or Google or whatever than buy shares in a gold mining company. Maybe I think it's just, it could be that it's, a signal here that the market is so neglected that it's a bargain. But I'm not sure about that, and I'm not a buyer.
WTI crude also had a significant drop and bounced back since we last talked. What happened with crude, and what are the key things to watch for in that market?
Yeah, every time we talk about crude, I keep going back to supply-demand, and the market will focus more on one side than the other. But certainly, WTI traded to $77, I guess, at the beginning of July. That was a 2.5-year high. Then last week we were down at just below $62. So, came off $15 or 20%, I guess, that quickly. As I think on the supply side, certainly we had publicly, everybody knows this, Biden asked OPEC and friends to increase production. I don't know if anybody paid any attention, but that was out there. But OPEC had a meeting where they decided to ramp up production a bit. If we back up to when the market crashed last spring, in March and then later in April of 2020, we actually went negative briefly in crude oil prices. At that time, OPEC and friends were making huge cutbacks in the amount of oil they were producing. So to try to rein in supply so that prices didn't stay low forever. And, that seemed to work. On the other side, demand did start to pick up. The demand had just been smashed, particularly things like jet fuel. Nobody was flying anywhere. So, I should say transport use of fuel really got whacked compared to other demand sectors. Now that came back, and then also, just as I talked a few minutes ago about the Canadian dollar, speculators got bullish. and there seemed to be a lot of bargain hunting, whether it was going just in crude or energy shares in general. And we had the party continue to the beginning of July at $77. And then maybe folks looking ahead, maybe worried about the Delta virus variant, leading to more lockdowns and, demand falling off while OPEC is scheduling increases in supply as they go into the fall, whatever. The speculators, I think, also as prices started to come off, they had to pitch out of their positions. There's been quite a change in what we call the time spreads. In other words, a month or so, 6 weeks ago, the premium for nearby crude oil was much higher relative to deferred months than it is now. So there's been quite a change in the runaway bullish enthusiasm for crude, and hence we've had this drop. Now, the drop was probably exacerbated last week, as I say, with the risk off tone that may have come from China, whatever just showed up in the currency markets and the commodity markets. And then, we've had this bounce from last week's lows. I think we're up $7 or so from this week, or from where we were at the lows last week. So, maybe all is forgiven. It's been a rock and roll ride here with crude. Again, I'd say it is late August. We'll see, whether or not that sorts itself out. But again, going into the fall, I'm anticipating some I'm going to call it tenseness or whatever, some stress in the markets. We've had such a one-way market in the stock market. If that starts to change, and believe me, from my perspective, the epicenter for measuring the risk-on or risk-off attitude of the market is the S&P 500 contract in the United States. And if that market started to get some weakness, I think it would be because that market was the reasons why that market was getting some weakness. That would also wash over into crude, and we could see crude prices lower. I know the last time we had talked, you asked me, did I think it was possible we'd see $100 crude this year? And I said, no way, Jose, I just don't see it. I could see, $10 higher wouldn't discipline demand very much, but, to jump from, at that time, roughly $70 all the way up to $100, that would really make a dent in demand. So, yeah, I'm guessing, barring some geopolitical freak out that would cause a spike in oil, I'm thinking we might have seen the high for crude here this year at $77.
You mentioned capital flows earlier in the show. It seems one sector of the market attracting a lot of new capital is the ESG sector. What does ESG stand for, and what do you think about it?
Well, it's environment, social, and governance. ESG has, let's say, a lot of well-meaning folks, want the world to be a better place. Good, less pollution, and so on. I have been of the view here for the last couple of years that regardless of what you think about ESG, like whether you're pro or against it, you need to pay attention because it's going to have an impact. On the one hand, ESG pools of capital that are ESG oriented are not going to invest in fossil fuel companies. So that might starve the fossil fuel sector from capital to do CapEx spending, and I think we're already seeing that to some degree. In a way, I remember ethical investing. I think that seemed to come along in the 80s or 90s, where ethical investing was, again, folks that wanted to not put their money into bad businesses. In other words, that you wanted to have an ethical fund that wasn't going to invest in tobacco, in booze. They wouldn't buy shares in a gun manufacturer. They wouldn't buy shares in a casino operator, gambling, that sort of thing. So, we've had, this is not new, and I think if you could go back to the days of the Pilgrims or something, there was things like ethical investing, but the current environment, social and governance aspect would be, there's been a lot of money come into that sector, and I think certainly we're seeing more and more institutional money. For instance, the people, not just fellows, that run, operate, make the trades for pension funds, like to be, seen as being politically correct. You can imagine, particularly some of them that are managing money for unions, who would want to say, well, "What are you doing? Investing in dirty oil? Why are you putting money into tar sands? Blah blah blah. That kind of thing." So the trend to ESG investing, I think, has got some momentum behind it, and we'll see more money come into ESG events. So that politically correct thing means, it's seductive. And I think my cynical side of me sees that historically Wall Street, and that's Bay Street or Lombard Street as well, and on you go, will create product to meet demand. And if people are clamoring to get into something that is just so pure and clean, they may overlook that the fees are much bigger there than they might be if they just went for a plain Jane passive investment. So, yeah, I think ESG is attracting a lot of capital. I think maybe it's been given a pass by a lot of people because it was so important to be doing the right thing. But I think maybe it'll be coming under the microscope in terms of, well, is the performance really all that good, and are they really all that green? When you look and see, they're not exactly just investing in, soap to clean dirty ducks. A lot of the money has just gone into the tech sector. So you could have just bought a tech fund and made as much money, if not more, without the fees. So obviously I'm sounding a little grumpy about it. I don't mean that. I just think it's really attracted a lot of money for, people want to do the right thing, but I'm not sure that it's going to continue to get a pass in terms of it's just so perfect you can't do without it.
In previous interviews, you've talked about how the central banks are passing the stimulus baton to governments. What does that mean, and why is it important?
I think the central banks have kind of hit the wall, actually. You get interest rates down to zero, and you can take them negative, as they've done in Europe or in Japan. Fed, it says that they don't want to do that. But, if interest rates are 1% set by the central bank, and still, people out in the economy don't want to borrow money, do you think if you drop them to 0.5%, that people are going to go, "Oh, I'll borrow now. Gee, that's a hell of a saving." Yeah. So I think that's part of it. On the quantitative easing side, where they kind of realized that lowering interest rates wasn't having as much impact as it used to. When you dropped interest rates from 15% to 10%, maybe it made a big difference. With the bond buying they're doing, we're seeing now that that money, that when the central bank buys some bonds from the brokerage community or the banks now have cash. They're just not turning around and investing that in the market or loaning it out to businesses. So I think the central banks are becoming less effective at stimulating the economy, and they know it. And now that we saw, particularly under the COVID, where the government came in so big with the stimulus programs, and that money goes straight to, call it the consumers who spend it. And it's going to be a more effective way to stimulate the economy than trying to, say, take interest rates negative and, double the size of quantitative easing that the central banks do. I think that the trend is there that going forward we'll see less stimulus coming from the central banks and more from the government, and it'll stimulate a different part of the economy than what the lowering interest rates did. That's just that. I guess I don't know really where to go with that. I just think that the central bank stimulus isn't working as much as it used to. We're going to see the government do that more, and I think there's just a trend anyway, certainly in Western society and demographically, for people to want the government to do more, and the politicians that are offering their platform are going to offer to do more. We need to do this, we need to do that, and so on and so on, and that takes more money. So that's where the stimulus is going to come from, not from the central banks. That probably creates a more inflationary environment in things other than, the stock market. So there'll be a lot of things that will change under that environment. Let me finish it with this. I think increasingly, whether it's in China or it's in North America or in Europe, that the government sees its purpose as redistributing wealth, and I think that's something that's been creeping up on us for some time, but I think that's going to just be a bigger and bigger part of what they're all about.
You spent 44 years working as a broker and portfolio manager, but now you only trade your own accounts. What difference has that made, if any, in the way you trade or look at markets?
Yeah, I guess, when you have clients, you're trying to manage expectations. And I have less expectations if I'm just trading my own money. I mean, I've seen a lot over about 50 years of trading myself and trading money for my clients. I don't have other people to bounce ideas off of as much as I used to, but it's it used to be said guys would leave Wall Street so they could maybe think more clearly, and you do think differently when you're a long way removed. You think about things like I'd say how little I really know. I mean, there's so much going on in the world that if I'm trying to make a trade in the market based on what I think I understand of the world, I'm woefully underinformed. So I don't do that. I mean, I can have opinions about different things, but mostly I trade price action. I'm thinking that that's where what the world is doing shows up. Where prices move. When I say managing expectations, a lot of folks would, when I worked as a broker, people would hate missing something. Gold's going up without me. Then our modern term for that is FOMO, fear of missing out. I mean, I don't have any FOMO. I mean, I have missed so many trades in my career I couldn't even imagine trying to count them. So I forgive myself about that, and just do the trades that I get. I watch a number of things, and sometimes I totally miss getting them, and other times I do. I think also, I have to trade what I think will happen, not what I think should happen. And a lot of times when you're talking to clients, I mean, particularly we were just talking about ESG. People would say, "Well, I don't think it's right that people should be investing in dirty oil." I go, "Well, okay, you got your opinions and they got theirs." To try to make trades on what you think should happen is just not the right way to go from my perspective. I think if you don't, for instance, I never really participated in the marijuana sector. I don't have anything against marijuana other than I just didn't trade it, and I missed fabulous opportunities. I mean, it was a hell of a market. But you just can't be involved in everything, so that was what I missed. With my trading these days, I guess my most important thing is I need to avoid taking big losses. And I've always been, or certainly most of my career, I've been about managing risks. When I say always, the truth is, when I was in my 30s and early in the brokerage business, I was very, very aggressive in the trading I did. I'd be, using more than 100% of the capital in my account to margin my trades, and I was hugely levered at that. So, I've been there, I've done that kind of thing, and had, big losses and big wins. But these days, I'm much more quieter in terms of the volatility of the P&L on my account. I just try to grind out gains, and if I'm not doing anything, I don't care. And nobody's phoning me up and saying, "Hey, we're not doing anything. Let's Don't just stand there, do something, that sort of thing. I wonder a lot, Jimmy, about where we are in terms of the cycle between greed and fear. I mean, the market seems to have virtually no fear. Greed, as it shows up in terms of margin and leverage and complacency and so on, seems really strong. I could go on and on, but let me finish with this. I think increasingly, when I reflect on the trading that I'm doing myself, the thing that's most important to me is time horizon. I have all kinds of ideas. During the course of a day, just looking at different markets and relationships between different markets, I think, maybe that's a trade there. Maybe that's something I could do. Maybe I could do this or that. And I really have to say, so what's the time horizon on that? You want to take a shot here on the short side of the stock market at all-time highs. And they go, no, don't do that. Don't do it. Yeah, well, I think it's going to go down. Well, yeah, have your thoughts, but how do you manage the risk on that? What time horizon? It's going to go down between now and Wednesday or down for the next 6 months? Got to really manage your time horizon. So, just managing risks, I guess, is much more important and talking to myself rather than than talking to other people.
Victor, we're in the middle of an election campaign in Canada. Is there anything you'd like to see the politicians say, do, or promise that could help investment in Canada, because we want to keep our country attractive to new business?
Oh, boy, oh boy. I think the market's pretty cruel in terms of just the facts, ma'am, just the facts, Sergeant Friday. I think the market is pricing in a liberal minority government, perhaps even the liberal minority government being a little smaller than it is now. It may be that the folks that decided now is a great time to call an election will wish they hadn't, but whatever. But in terms of, is there anything anybody could say that would make Canada better? Jimmy, I just don't know where to go with that. That's a very open-ended question. I mean, personally, I would like to see that, I think our Prime Minister said a week or so ago that, forgive me, I just don't pay any attention to monetary policy. That may have been a little taken out of context, but you go, oh my God, really? Yeah, I guess he's probably telling the truth. That it would seem, some of the ideas that he has, that he doesn't. I'm old school. I like fiscal responsibility. I like cost-benefit analysis and that sort of thing. And but that's just to go back to what I was saying moments ago. I need to trade what I think will happen, not what I wish would happen or I hope or would hope that would happen. I think we're going to more and more and more government in our lives, people looking at the government to do more and more things. And, we're on this little program now where it seems we can just print money and there's no consequences to it. I think that's probably going to get us in trouble, but that's certainly not popular. So I don't expect anybody to come out and nobody's going to get elected, I guess is what I'm saying, running on that kind of a program.
Victor, thank you so much for being on This Week in Money.
Jim, it's always a pleasure to talk with you. Thank you for having me on.
My guest has been Victor Adair, recently retired from over 44 years of being in the brokerage business in BC. He still publishes a lot of financial information on his website, victoradair.ca. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and thank you for listening. If you have any questions for our guests or the show, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase, Larry.
Well, thank you, Jim.
Busy day in your office this week. 2 news releases.
Yes, we had 2 news releases that were some of the best that we've ever done, aside from the one we did the week before. And, we're reaching the end of our test work. And so the new news releases were on black mass testing that we did for a big, I guess you'd call it an electric vehicle company. And we got excellent results and an excellent response on the market. And the second one was on our final product for the test work we were doing for the Department of Defense, the DLA, Defense Logistics, and that was a good turnaround too. So 2 great releases, and the stock has gone up. Last I looked, around 35% since Monday, and that's a big jump. Anybody buying the dips would be very happy today, and anybody selling on from the news from the CEO and billboards will be very unhappy today. But I think this is the beginning of a recycling market that is going to turn a lot of heads in the future. Now, we couldn't be happier in here. I have to say that these results that we've been waiting for some time, finally has turned the market around for us, and everything going forward is going to get much, much better, I see. So that's a great time for us, Jim. We have we've taken black mass now, and we've turned it around and got a 99% recovery in the black mass. And we've run it right through the whole program to the right down to the particle sizes, and returned that black mass to the OEM. And let's face it, nobody else can say the same things that we do. And it's been a long, tedious road to get here. And it was a lot of struggle to get all the money together to get it to this point. And now we're in trading above $1 and close to $1.30 the last I looked, and it's a new game for us. It's like the company has got a new life, and it's based on good, solid research and development and work that has brought it to this point. And we could have jumped off the ship a year and a half ago and started producing an inferior product that we probably would have been in production by now. But the truth of the matter is, you got to make money. If you can't make money, you don't last long out there. And that's what we want. That's one of the first things, or the second thing that we looked at. We look at saving the environment, and then we say, how profitable is this? And as far as we can see, on the back of the envelope, it's very profitable. And, I get a lot of criticism about having NDAs, but we got a lot of big companies that are interested in what we're doing. And they insist on NDAs, and we put those out to them. We supply them with all the results that are happening, and somebody's going to jump one of these days. Probably not for a few months, but when that does happen, then it's another ball game. I mean, that would be a joint venture or some kind of a licensing agreement for a number of factories. So it's I couldn't be happier. It's a good way to end the week, and of course the week's not over. It's only 11:30 now. There's still an hour and a half in the market to go, but we're close. Like I say, we're getting close to $1.30. We're $1.28 at the moment, and it's got to make the shareholders happy. Certainly they don't send me emails, or some certainly do, but most of them, just basically don't acknowledge the hard work the company's doing. But, as long as they're holding their stock, they're going to make a lot of money. And I talked about my retirement coming up. I don't know, it could be a year and a half out or 2 years out, but I told everybody what my plans would be, and I want to stay in this field. So my major investment will be still Amy, and I'll have enough money to do a few things that I want to do. But with this COVID thing, it's becoming more and more critical that every time they open up, they shut down, and so everybody wants a timeline. How do you give a timeline during COVID? That would just be optimistic thinking, and with that shadow over the market, timelines are going to get skewed. And, so I'd sooner be criticized for not putting one out. We put out our news, everybody can see our progress, but timelines are something that I've done. I was one of the first ones to do a timeline on molybdenum back in 2004, and we met those timelines. But we didn't have we weren't facing the same adversity as we face today, especially with COVID. So, timelines, maybe once this next section is done of the 500 kilogram testing per day on a continuous basis, maybe we can do a timeline. But even at that, you don't know. If a key person is out of the picture for 2 weeks, that's a slowdown in the timeline. Or a key piece that you need, you can't get for 2 months. It just screws up the timeline. So, no, I don't do timelines, and because your feet get held to the fire no matter what the effects are. Could be a tsunami, a hurricane, a tornado, an earthquake. People don't care. They wonder why you didn't make the timeline. And but I think we keep our base informed, and that's been the key of our whole campaign, is to keep the base informed and aware of what we're doing. See our progress, map it themselves, and if they want the answers, they're there. They're in the press releases. They're on the site. There's PowerPoints on the site. Everything's there that they can see, and I don't think there's any other company out there doing the same things that we are. So it's been a great week so far, Jim. And I think we, are going to have a lot of happy shareholders, even if it closes at $1.25 or $1.35. It's still going to make a lot of happy shareholders out there. Those that listened to me in the past podcast where I said buy the dip, certainly would be smiling today. And some of the messages I got where people were thinking about selling. And, I tried to encourage them not to, but that's as far as I can go. It's up to them if they want to sell. And so they can't blame the management for selling. They can't blame the management for buying. It's, we see a great opportunity here. Certainly I do. I'm one of the largest shareholders in the company and probably one of the largest investors. And it's getting rewarding, and it's actually very rewarding, and I can see this thing moving up into different, much higher areas. That's my opinion, and I'm not an analyst, although I do analyze a lot of stuff. I'm not a registered analyst, so I can't come out and say what the price is going to be. But what I see is I think my dedication to the company proves that, and so we're just happy campers here, Jim.
Larry, for people new to American Manganese, what does the company do?
The company is a critical metals company that got involved in R&D work for manganese back in 2008, and we filed a patent for that in 2012. We actually took a very low-grade deposit in Arizona right through the pre-feasibility study, and at the same time as the study was, we were getting results from the study, the price of electrolytic manganese metal started dropping. And that put everything on the shelf until 2015, when we decided maybe we should be looking at doing, going into the battery industry. As encouragement from Cametco that they felt that this would work. We moved ahead with that in 2016. We broke out of the 1.5 to 2 cent range and went up to 35 cents, back down to 20 cent range for the next 3.5 years. But we managed to raise millions of dollars to advance the recycling project, and it's been a lot of hard work. It hasn't just happened overnight. It's starting to look like it may just be happening overnight, but that's not the case. And the ones that stuck with it have already seen huge profits. Some of them became multi-millionaires, or at least millionaires, almost overnight here this year. And and some of those have been with me since back in the manganese days. So I couldn't be happier. We certainly, I'm hoping that we'll break the last high we had sometime in the next 6 months, and go on to higher areas for the company. So that's kind of the history of the critical metals part. We trade on. Actually, you can get all the information you want by going to our website, AmericanManganeseInc.com. Or you can check us, our stock ticker on the Toronto Venture Exchange and symbol AMY. You can go to the QB board under the symbol AMY. ZF, you can go to Frankfurt Exchange under the symbol 2AM. And you can phone the company here at 778-574-4444. And or you can email me at LREAUGH@AMYMN.com. And if you have questions, please give us a call. Please phone. Phone's faster.
Larry, thank you so much for the update.
You're welcome.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on August 27th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.